Welcome back to another video. Today we're going to answer the question of how much cash should I be holding as an investor? Whether you're just starting out or whether you've been in the game for years, this is a question that most investors generally grapple with. With UK savings rates currently at quite impressive highs, you might be questioning whether now is the right time to increase the cash portion of your investment portfolio. Unlike stocks and bonds, cash savings don't carry the risk of losing value like those other two options. So it begs the question of why take on the additional risk when savings accounts are better than they have been in years? While this may seem like a logical choice, there's a few factors you need to consider here. Today we're diving into those factors, and hopefully by the end of this video you'll understand whether you need to increase or potentially decrease your cash allocation in your investment portfolio. Okay, so the first point to cover is in the form of an emergency fund or cash holding. Prior to investing, it's always recommended to firstly pay off any high interest debt, but secondly build up an emergency fund. This spare cash pile is to cover against the unexpected. This could be things such as your boiler breaking down, car repairs, your washer and dryer breaking, or other household electronics. And potentially the biggest factor here would be periods of unemployment. Maintaining an emergency fund will reduce your risk of going into debt or potentially having to sell any investments at a loss. For one-off expenses, one rule of thumb is to keep the greater of £2,000 or half a month's expenses in a bank account. When it comes to an income shock, I suggest keeping 3 to 6 months worth of living expenses in an accessible savings account. This is to cover your basics such as rent or mortgage, utility bills, food, transport, and any direct debits or monthly payments you may have. Whether you save 3 or 6 months or somewhere in the middle, that's entirely up to your own risk tolerance. I would suggest if you have any dependents to go for the higher end of this scale. I personally hold 6 months worth, but that's purely so I can have peace of mind. So moving beyond this emergency fund, holding excess cash in your investment portfolio could cost you in the long run. There's a term in investing called risk premium. This is the additional return that investors get for taking on extra risk. When you invest in shares and bonds, there's a risk of losing some or all of your investment, but there's always a premium to compensate for this. There was a recent article from Vanguard that added some statistics behind this. Vanguard say that they expect cash to deliver annualised returns of 3.4% over the next 30 years, compared with 6.9% for shares and 4.3% for bonds, based on the average market conditions. Shares and bonds will always experience volatility along the way, but that doesn't mean you should move all your investments into cash when the market is particularly volatile. The chart here shows how moving to cash for just a few months can lead to significant underperformance. It shows 3 examples of investor behaviour during the COVID-19 market downturn. This grey line at the top here, this shows a person who stayed invested throughout. The green line here shows someone going fully to cash in the week of the 18th of February 2020 and reinvesting in the week of the 7th of July 2020. Then we've got the orange line. This is someone who moved their investments fully to cash in the week of the 20th of March 2020, which was when the market bottomed out, and then they reinvested on the 7th of July 2020. The investors who fled the market, and even those who sold out partway down, ended up with much lower returns than the investor who remained invested throughout. As a long-term investor myself, I don't move my money around when the market does have a downturn. Instead, I buy more. Going off the example we just looked at, if you'd have held your investment, you would have been a lot better off. I hope that's given some food for thought. So where does this really leave us? We don't yet have a clear idea on how much cash we should hold. There's 3 factors to consider when deciding whether to include cash in your investment portfolio. Firstly is your risk tolerance. The second is your time horizon, and the last one is how close you are to achieving your goal amount. Starting with the first one, risk tolerance relates to how you feel about risk and is a measure of how much investment risk you're willing to take. Cash savings typically have low volatility, so if your risk tolerance is quite low, then you might want to up your cash holdings. But I'd always be mindful with this. Over the long term, you could be really hurting your potential financial growth. On the other end of the scale, if you're okay with the higher risk tolerance, then you might want to up the amount you put into stocks and bonds. The second point is time horizon. For me, it's possibly the biggest factor here. Your time horizon is how far away that investment goal is. This could be saving up for a house, or it could be something such as saving for retirement. If you have a short-term goal, such as saving for a first house, you might want to consider having the majority of your investment in a high-yielding savings account. You may be thinking straight away here, but surely I'll get better returns in the stock market. Well, that technically is true. The S&P 500, for example, returns on average around 10% per year. But the key word here is average. It's not a given 10% per year, it's an average. If we look here, we can see the S&P 500 returns over the last 30 years. Yes, there's a lot of green, however don't ignore these years where the market was down. Take 2022 for example, the market was down almost 20%. Around 2021 and 2022 would have been a terrible time for you to have invested savings for a house. Cash is useful for the short-term goals because there's no risk of a stock market depleting your funds just before you're about to use them. However, if your time horizon is much longer, you can ride out the market ups and downs and really gain from the market average growth. The chart below shows our expectations for cash, bonds and shares over a 1-year and a 10-year time horizon. The coloured bars show the expected range of returns and figures in the red circles show the expected median returns on an annualised basis. The data shows that the longer you invest, the narrower the expected range of annual returns, particularly when it comes to shares and bonds. So while shares and bonds are more volatile, long-term investors have more chance of riding out the market ups and downs and benefiting from the risk premium from shares and bonds. Whereas the cash savings part stays at a consistent 3% with quite low volatility. The final factor is to consider how close you are to that investment goal. Now if you're investing or saving for the long term or for retirement, you may be happy pumping money into stocks and shares as you can ride out any market volatility over the long term. However, as you draw close to the point you'd like to use this money, this may be where you want to revert and move more money into less volatile options such as bonds or cash, as your capacity to handle risk will likely reduce. By this point, you almost revert back to the short-term goal methods. It almost goes full circle. So to sum it all up, there's not really a one answer fits all. It depends on your risk tolerance, your time horizon, and how close you are to that investment goal. If you're in the early stages of investing for the long term, keeping more stocks might make sense. Whether it's retirement or another financial milestone, shifting towards safer, less volatile options such as bonds or cash can help protect what you've built. As mentioned just now, there's not a one-size-fits-all answer here, but understanding these different methods, it can help equip you for making the right financial decision depending on your investment goal. Thank you for watching, I hope you found this quick video useful. If you've enjoyed this content, then do feel free to like, comment and even subscribe to the channel. It really helps the channel in these early stages. Thank you for watching and I'll see you in the next one.